Welcome to Breaking News to Trading Moves. Welcome to the debate. When a Formula One car smashes into the retaining wall at 200 miles an hour, the telemetry team, they immediately looked at the data. They checked the suspension, the tire pressure, the steering column.
Right, they look for a mechanical failure, like a snapped axle or a blown gasket.
Exactly. But then you watch the onboard camera and you see the driver simply flinched. The mechanics are flawless, but the human panicked.
Yeah, that happens a lot more than teams like to admit.
Right. So when we look at traders who consistently lose capital, we have to ask that exact same question. Is the root cause a lack of mechanical discipline and structured systems, or is it, at its core, a failure of human psychology and emotional regulation?
It is the eternal question of the markets, honestly. And it is where the most money is made and lost.
Absolutely. I take the position that trading success relies on rigid mechanical systems, specific pre-trade protocols, and strictly managed risk metrics.
And I take the position that regardless of the system used, human cognitive biases, things like loss aversion, ego, and regret, will always override those mechanical rules unless the underlying psychology is mastered.
Let me lay out the foundation from my perspective here. Failure in the markets comes directly from an absence of a systemic framework. If you step onto a proprietary trading floor, you will encounter the concept of one good trade.
That is a very specific philosophy. How do they define it in that environment?
So it is a philosophy where success is defined strictly by following a pre-planned mechanical process, not by, predicting where the market is going. The outcome of the trade actually does not matter.
With the outcome doesn't matter?
Not for this metric, no. If you followed your entry rules, adhered to your position sizing, and executed your stop loss, you made one good trade, even if it lost money. Destructive behaviors, the ones that blow up accounts, are systemic failures. They can be entirely neutralized by implementing rigid rules.
Okay, but what do those rules look like in practice? Give me an example.
They look like mandatory 15 to 30-minute post-trade cooldowns and fixed 1% to 2% risk limits per trade. And these are not just suggestions. In a professional firm, the software enforces them.
Right, the system physically stops you.
Exactly. When you build guardrails, the car cannot go off the cliff. You remove the need for willpower entirely by replacing it with a physical, mechanical rule.
I understand the appeal of that. But destructive trading behaviors are firmly embedded cognitive problems, not merely rule-breaking. You can build the strongest guardrails in the world, but a panicked driver will still find a way to crash.
How so, if the car literally can't turn?
Because the driver is human. Let us look at Daniel Kahneman and Amos Tversky's prospect theory. They demonstrated that the psychological pain of a loss is twice as intense as the pleasure of an equivalent gain.
That biological reality is well documented.
Yes, it is biological. It is not something you can just turn off by reading a rule book. A trader's ego and the narcissistic need to be correct, which Mark Douglas outlines in his work, Trading in the Zone, causes measurable cognitive impairment.
Sure, stress affects cognition.
Exactly. When a person is under severe financial stress, their systems will invariably be abandoned. The mechanics do not matter if the operator's prefrontal cortex is hijacked by emotion.
Let us test that against the data, specifically regarding the origin of the disposition effect. We know that traders tend to sell their winners too early and hold their losers too long.
Yeah, classic problem. Like every trader does it at first.
Terence O'Dean's 1998 data, which analyzed 10,000 brokerage accounts, showed exactly how pervasive this is. Investors realize gains at a rate of 14.8%, while only realizing losses at a rate of 9.8%.
Those numbers are stark, honestly.
They are, and my argument is that this tendency is solved purely by mechanical action. It is solved by executing predefined stop losses without a single second of hesitation.
And you think human beings can just be programmed to do that? Like robots?
I think they can be trained to do it. Think about hitting the cutoff man in a baseball game. It is a drilled, unthinking reflex. It is a core practice, not an emotional choice.
Right.
The outfielder does not stop to ponder the emotional weight of the throw. You catch the ball, you throw to the cutoff man. You see the stop loss hit, you exit the trade.
I come at it from a different way. You are treating the execution of a stop loss as if it is emotionally neutral, like throwing a baseball. But a baseball player is not losing a portion of their net worth when they throw to second base.
Well, the financial stake changes the pressure, certainly, but the required mechanic remains the same.
But the mechanism of failure is completely different. The disposition effect is driven by mental accounting and regret avoidance, as outlined by Sheffrin and Statman in their 1985 study.
Let us clarify mental accounting for a moment, just so we are on the same page.
Gladly. Mental accounting is how the human brain categorizes money. A trader will put a paper loss, a position that is currently down but still open, into a different imaginary bucket in their brain than a realized loss.
Ah, so they trick themselves into thinking a paper loss is not real money yet.
Exactly. Closing a losing position turns that paper loss into a realized loss. That action generates profound psychological regret.
Because it forces them to admit they were wrong.
Precisely. In fact, Weber and Camarora conducted an experiment in 1995 that gets right to the heart of this. They created an experimental market where participants bought and sold shares.
Okay.
In one version, the participants had to manually decide to sell. In another version, all shares were automatically sold at the end of a specific trading period, and participants had to decide whether to buy them back.
So the decision to hold was completely reset by the automation.
Right. And the disposition effect diminished almost entirely when the shares were automatically sold. That proves that human emotional reluctance to click the button is the actual bottleneck.
Wait, hold on.
When the human is forced to execute the action, the pain of regret stops their finger. The system fails because the psychology is broken.
That is a compelling study, but I would argue that the Weber and Camera experiment actually proves my point.
How so? That makes no sense.
Hear me out. Because when the shares were automatically sold, well, the disposition effect was greatly reduced. That is exactly what a mechanical system does.
Oh, I see where you were going with this.
Right. If you use a hard, automated stop-loss order on your broker's platform, the computer clicks the button for you. The regret avoidance you mentioned is entirely circumvented by the machine.
But the machine is still operated by a human.
Yes, but the action is preloaded. Shifrin and Statman even suggested that professional investors use these self-nudges like automated stop-loss orders to avoid what they called get-evenitis.
Get-evenitis? That's a new one.
Yeah. It is the desperate desire to hold a bad position just to break even and avoid realizing a loss. If you are listening to this right now and you have ever moved a stop-loss down just a few pennies right before it hit, just to give the trade a little more room.
Oh, everyone has done that. I've done that.
Right. Then you have experienced mental accounting in real time. The mechanical rule, the automated stop, solves that psychological defect.
Okay, but who programs the machine? The trader. And who can cancel the automated stop loss right before it hits? The trader. No system is fully autonomous if the person at the keyboard can override it.
I mean, that is fair, but...
Let me finish this thought, because that brings us to the reality of tilt and revenge trading. Let me walk you through the biological trigger sequence of revenge trading.
Please do.
A valid trade hits the stop loss. The trader loses money. The brain processes financial loss using the exact same neural circuitry that processes physical pain. Frustration builds, right?
Mm-hmm.
The amygdala fires, which causes the adrenal glands to release cortisol and adrenaline into the bloodstream.
The classic fight-or-flight response. We've all been there.
Precisely. And what happens during fight or flight? Blood flow actually moves away from the prefrontal cortex, the part of the brain responsible for logical calculation and risk assessments.
So they lose their ability to reason.
Exactly. The trader then impulsively re-enters the market with oversized risk to erase the pain. The sunk cost fallacy keeps them holding bad positions because they feel they've invested too much money and too much emotional energy to walk away empty-handed.
They eventually snap.
Yes. No automated stop-loss survives a trader who is actively experiencing a cortisol spike. They will just re-enter the market manually, abandoning the system completely.
I see why you think that. But let me give you a different perspective. That physiological reality, the cortisol spike, the impaired prefrontal cortex, is exactly why traders must rely on environment design, rather than emotional suppression.
Environment design meaning the software restrictions we discussed earlier?
Yes. You cannot outthink biology, so you must design a workspace that physically restrains you when your biology fails. Mechanical systems do not exist to make you a better trader.
Then what do they do exactly?
They exist to physically lock you out when your biology inevitably turns you into a bad one.
But how does that practically stop a trader mid-spike? I mean, really?
If a system has a hard daily loss limit coded into the firm's risk management software, the trader is locked out, period. They cannot override it.
Okay, in a prop firm, sure.
Even retail. If they have a rule to physically close a trading platform and walk away for 30 minutes after a loss, the decision is entirely removed from their impaired brain. We are not asking them to be stoic monks.
No.
No. We are asking them to follow a pre-trade protocol that limits real-time feedback loops, hide the profit and loss column during the trade, use auditory alerts instead of staring at flickering charts.
I'm sorry, but I just don't buy that. Let me tell you why. You are assuming the trader will, actually obey the environment design. You are assuming they will actually close the laptop.
If they want to keep their capital, they will.
But if their ego is tied up in the trade, they will not close it. They will log in on their phone. They will open another brokerage account. They will find a way to trade because the urge to erase the pain of a loss is overwhelming.
You are describing a severe lack of discipline.
I am describing human nature under financial threat. Mark Douglas points out that traders fail because they tie their self-worth to being right.
Which is a mistake.
A fatal one, really. The market does not care about your opinion. It does not care about your analysis. Success requires a complete psychological transformation to accept uncertainty and treat every trade as a statistically independent event.
Treating trades as statistically independent is the core of probability.
Yes, but until you sever the emotional link between your self-worth and the outcome of the trade, environment design is just treating a symptom. It is like a gambler blowing on the dice before a roll.
That is a bit dismissive, don't you think?
Not at all. The brain is trying to assert mechanical control over a purely statistical event. If the underlying need to be correct is not resolved, the trader will bypass every software lockout you invent.
It is absolutely critical to treat each trade as statistically independent. I agree completely. But how do you actually train the brain to do that? You do not do it by meditating.
Then how?
You do it through the mechanics of reading order flow and executing predefined setups.
Walk me through what that looks like on the screens.
Take the strategy of trading stocks and play stocks with fresh news catalysts and high relative volume. Trading is a game of math where your edge comes from recognizing specific setups and hitting bids without hesitation.
Okay. Order flow is the actual buying and selling happening in real time. When you see a large buyer stepping up on the tape, you execute.
And you are saying the repetition of that mechanic changes the psychology.
Exactly. When you mechanically execute a strategy 1,000 times and you strictly manage your risk to 1% of your capital, the outcome of any single trade loses its emotional weight.
That is a big assumption. It is proven by volume. The mechanical execution ultimately trains the mind to remain calm. Numbness to the outcome is a learned behavior. The process of adhering to strict rules is what creates the psychological detachment you are talking about.
That assumes the trader survives long enough to execute 1,000 trades without blowing up their account first. You mentioned risking 1% of capital. That is a great mechanical rule.
It is essential.
But when a trader faces a losing streak, recency bias kicks in.
Recency bias being the tendency to overweight recent events over historical data.
Right. They focus entirely on the pain of the last 3 losses, completely forgetting the probability of their 1,000 trade sample size.
They lose the forest for the trees.
Exactly. I mean, they convince themselves the next trade is a guaranteed winner to make up for the losses, and they size up to 5% or 10% to recover faster. The psychological desire for revenge dismantles the mathematical reality of the 1% rule.
But surely professionals with established track records overcome that.
You would think so, but the data says otherwise. In a paper from 2023 by Akapanita-Warren and colleagues, they studied institutional investors. They found a systematic, costly discrepancy in how these professionals sell versus how they buy.
What was the discrepancy?
Even the professionals, who have all the mechanical systems, all the algorithms, and all the risk managers in the world, underperform when closing positions.
Really? The pros do this?
Yes. The researchers found they allocate cognitive resources asymmetrically. They spend all their time and brainpower finding the perfect entry, but when a trade goes against them, cognitive dissonance takes over.
Cognitive dissonance being the mental conflict of holding two opposing beliefs. In this case, I am a smart professional and I am losing money.
Precisely. To resolve that conflict, they hold on to the losers, hoping the market will turn around and validate their intelligence. If the most systematically restricted institutional investors on the planet fall victim to cognitive dissonance, it proves the underlying psychology is the ultimate driver of failure.
I hear you. Yet, if we look at the proprietary trading world, the individuals who survive are the ones who relentlessly review their metrics. They use programs to track their win rate, their profit factor, their mathematical expectancy.
They quantify their behavior.
Yes, and by quantifying their actions, they remove the narrative of the ego, When they review a bad week, they do not say, I am a failure. They say, my win rate on this specific breakout setup between 10 and 11 in the morning is dropping below my threshold.
That is very clinical.
That is a mechanical, data-driven approach. It leaves no room for the ego to attach itself.
But data review happens after the market closes. What happens in the heat of the moment?
You force a pause. If you force a trader to fill out a pre-trade checklist specifying the entry price, the stop-loss price, and the profit target before they are allowed to click buy, you are inserting a mechanical pause that short-circuits the emotional brain.
A speed bump.
Yes, it forces the prefrontal cortex back online.
A checklist is a wonderful tool, provided the person holding the pen is rational. But think about the trader who has just watched a stock gap down against him. They are experiencing what Leroy Gloss called get-evenitis.
The condition you mentioned earlier.
Right. They are staring at a massive red number on their screen. In that moment, the checklist feels like an obstacle to their survival.
Because they are operating in a state of, sheer panic.
Exactly. They throw the checklist away because the amygdala is screaming at them to fight or flight. To truly solve this, the trader must engage in rigorous psychological maintenance.
Like what? What does that look like?
They need to journal their emotional states, not just their entries and exits. They need to track their level of frustration on a scale of 1 to 10.
I see.
If they feel they are at an 8 out of 10 on the frustration scale, they must recognize that their edge is gone, no matter what the chart looks like. The mind is the ultimate filter, through which all mechanical rules must pass. If the filter is clogged with ego and fear, the rules are completely useless.
I will concede that a trader must have a baseline level of self-awareness to recognize when they are compromised. However, relying purely on psychological fortitude is a dangerous game.
Why is it dangerous?
Because it implies that we can somehow, meditate our way out of bad trading. We cannot.
It is not about meditation. It is about self-mastery.
But the market is actively engineered to exploit human psychology. It induces fear of missing out during massive green candles and sheer panic during sharp drawdowns. Because we know the market is a psychological minefield, we must rely on rigid structure.
But we just proved that structure fails under stress.
I disagree. Placing mechanical guardrails, enforcing strict position sizing, and mandating rigorous pre-trade structures provides the most actionable path to consistent profitability. It takes the burden of decision-making off the trader's limited emotional reserves.
And I maintain that without addressing loss aversion, ego, and the acute pain of regret, the most robust mechanical system will eventually be dismantled by a stressed human mind. You can put all the software lockouts you want on a platform, but if the operator cannot handle the emotional weight of being wrong, they will find a way to sabotage the account.
That is a very bleak view of human discipline, don't you think?
It is a realistic view of human biology. The trader must confront their own ego and accept that the market owes them nothing. Only then can any mechanical system function as intended.
Well, we have covered a lot of ground today, analyzing the tension between mechanical structure and cognitive realities. It is clear that we both agree trading is an ongoing practice of refinement.
Absolutely. It requires both an acute awareness of one's own psychological limitations and a strict dedication to process over outcome. The best traders know exactly where their minds fail them, and they use every tool available to counter those failures.
Exactly. So look at your own trading history. Are your losses a result of lacking a defined mechanical system or a failure to emotionally abide by the system you already have?
There's always more to explore in the material, and ultimately, you must be the judge of your own trading psychology.
Think back to that Formula One car hitting the wall. The mechanics of the vehicle and the composure of the driver must work in absolute harmony to cross the finish line. Thank you for joining us on The Debate.